Greetings. I'd like to welcome you to the first of four events that we are holding this week at the Center for Global Development, looking at different aspects of financing for low-income countries. This is a topic on which there have been a number of conversations and papers written recently, and we're going to have an opportunity to review some of that work in the panels that we have this week. Today, we're going to talk about debt. And then in the remaining three sessions, we're going to look at domestic resource mobilization, financing from countries' own resources. And then we're also going to look at the prospects for private sector financing for low-income countries. And finally, we're going to have a session where we bring together these different strands and try to see what are some practical ways forward. And I hope that during these sessions, we're going to have a combination of realism and creativity. Realism in recognizing what are the issues and prospects. Sometimes I find in these conversations, we sort of assume away the problem because we're unrealistic about what's going to happen. I think it's important to recognize what is coming down the road and then to be creative, because once you recognize the size of the problem, we'll be able to see what can be done about it. Today, we have a terrific panel. Clémence Landes is going to moderate that panel. And without any further delay, what I'd like to do now is hand over to Clémence to introduce our panelists and get us started. So over to you, Clémence.
Thank you, Masood, and good morning to everybody. As Masood just mentioned, today's panel will focus on addressing issues around debt sustainability in low-income countries in light of the magnitude and likely length of the economic shock they're currently confronting. Nearly half of low-income countries are at risk of or in debt distress, and extreme uncertainty prevails in today's global environment. The international community has taken steps, including the DSSI, to bolster countries' resilience and their ability to face the shock. But more systemic and bold solutions will likely be needed. So as Masood pointed out, today's conversation we really hope will focus on these solutions. And here are some of the burning questions we confront. How do we maximize LIC financing without kicking the can down the road and building an even worse debt crisis? How can we get enough money to countries facing liquidity crises so these do not turn into full-blown solvency crises? How do we design a debt relief framework for the countries that need some forgiveness that involves full and equitable creditor participation? And how can we make lending and borrowing more transparent and sustainable going forward? And finally, what fundamental reforms do we need to make to the broader financial architecture for sovereign debt resolution, which seems sometimes so badly outdated? So in terms of the run of show, we'll kick off this session with a presentation from Sarah Jane Clifton, who's the director of the Jubilee Debt Campaign. And this will be followed by interventions from our panelists. We have Sonja Gibbs, Carmen Reinhart, and Maxwell Opoku-Afari. And then we'll open it up to our moderated discussion with our invited guests. And then finally, we'll be taking questions for the panelists from the audience. So before handing it over to Sarah Jane Clifton, let me quickly introduce our panelists. Sonja Gibbs is the managing director and head of sustainable finance at the Institute of International Finance. She co-leads IIF's work on sustainable finance and infrastructure investment, including advocacy and liaison efforts vis-a-vis the G20, the multilaterals, and the international regulatory community. Carmen Reinhart is the vice president and chief economist of the World Bank Group. She is currently on public service leave from the Harvard Kennedy School, and she serves on the advisory panels of the Federal Reserve Bank of New York and the International Monetary Fund. And finally, Dr. Maxwell Opoku-Afari is the first deputy governor of the Central Bank of Ghana. Prior to this appointment, Dr. Opoku-Afari worked at the IMF in various capacities, including as mission chief and deputy division chief in the African department. And finally, one more housekeeping item. If you are in the audience and you have questions, please send them over either via YouTube, email at cgdevents@cgddev.org, or via Twitter at cgddev or hashtag cgdtalks. And with that, let me pass the metaphorical floor to Sarah Jane Clifton to kick us off.
Thanks, Clemence. Hi, everyone. My name's Sarah, Sarah Jane Clifton. I'm Director of Jubilee Debt Campaign. We're a UK charity working to tackle poverty caused by unjust debt through research, education and campaigning. We're very grateful to the Centre for Global Development for commissioning this paper, which I'm going to present to you today. The debt crisis in the Global South has been a priority for us. Sounding the alarm really on the debt crisis has been a priority for us for the last few years. And we're really grateful to be able to show some more analysis around this. I should just say that I'm not the actual author of this research. My colleague Tim, who authored the paper, has just had a baby girl. So that's why you've got to make do today with me rather than him, but hopefully I'll be able to do it justice. So I'm actually going to give a PowerPoint presentation and share my screen. So just 1 second. Hopefully that is working for everybody. Great. So for this research, we focused on the 63 countries which have had debt sustainability analysis from the IMF and World Bank in 2018 and 2019. Probably many people here on this call are aware, but the debt sustainability analyses are conducted for all low-income countries, for some low and middle income countries that have recently graduated from low income status, and also for some upper middle income countries which are considered particularly vulnerable small states. And for these countries, we looked at two things: the trends and projections in debt payments from 98 to 2030, and then a comparison with the trends in changes in average real public spending per person from 2015 to 2019. So I'm going to show you some of the findings and also the conclusions that we drew from that. Just to say that a bit more on the indicators. So for the indicators on debt payments, we looked at two figures: the government external debt service as a proportion of government revenue, and also the government external debt service as a proportion of government revenue and domestic debt interest. Just to say, we regard these debt payment figures as a better guide to debt burdens than government debt as a percentage of GDP, which is often the measure that's used. This is because debt to GDP takes no account of a number of things which we think are important when considering the debt burden of a country. These include the interest rates that are being paid on the debt, how much government revenue is actually being collected, which can be used to pay the debt, who the debt is owed to and whether it's external and creates a balance of payment risk, and also what currency the debt is owed in, and so whether it creates an exchange rate risk as well. So for the purposes of keeping this presentation not too lengthy, I'm actually only going to present this first set of figures, so the government external debt service as a proportion of government revenue, but the other figures are obviously available in the paper if you would like to read them. And the conclusions I'll present obviously are drawn from analysis of both sets of figures. So for the government external debt service as a proportion of government revenue, this graph shows the mean average public external debt service for the 63 countries for the period 1998 to 2030. All of the averages that we've used are unweighted, so they treat all countries the same regardless of economic size, and that's to ensure that a few countries don't dominate the figures and gives a suggestion of what's happening across a range of countries. The blue line is the actual figures, 1998 to 2018. So to tell you a bit about the explanation around that to start with, we see that the average unweighted public external debt service for the 63 countries fell from around 16% of government revenue in 98 to a low of 5.5% in 2011. This was because of the debt relief under the Heavily Indebted Poor Countries Initiative and the Multilateral Debt Relief Initiative, as well as increasing commodity prices. Then we see from 2011 that debt payments have been increasing again, reaching an average of 12.4% of government revenue by last year, by 2019. So this was a rise between 2011 and 2019 of 125%. Then we have the orange lines and the grey lines. These are for the projections into the future. So the IMF produces two scenarios. The orange line is the average of the IMF's baseline scenario. So this is the main predictor from the IMF of what will happen in any individual country. These baseline scenarios tend to be very optimistic. They assume strong economic growth alongside falling budget deficits. The grey line is the average of the IMF's one economic shock scenario. So this is what the IMF predicts will happen if there's a particular economic shock, for example, a local currency devaluation, a fall in export revenues, or lower government GDP. It's important to note that both of these scenarios, the grey and the orange one, were produced prior, or based on analysis produced prior to the pandemic. So under the IMF baseline scenario, average external government debt service was due to keep increasing and to reach 12.8% of revenue by 2022. That's an increase of 133% on 2011 levels. And under the one economic shock scenario, average external debt service rose even further to 17.4% of government revenue by 2022, which is an increase from 2011 of 216%. Then average external debt service stays at a similar level and is still around 15% in 2030. The critical thing to note here, as I said, is that COVID has imposed not one, but multiple major economic shocks on developing countries. So that grey line now looks extremely optimistic / unrealistic, and I'll come back to that later. This second graph is the mean average for the same figures. The previous one was the, this is the median average. The previous one was the mean average. You'll see that this follows a similar pattern, which shows that the increase in debt payments is not just due to a few outliers. So then we looked at how public spending has changed in real terms between 2015 and 2019. The data is only available for 60 of those 63 countries, and we compared this to how the external debt servicing and domestic debt interest payments had changed. Here, the findings are very striking. So, first of all, for the 30 countries with the lowest debt payments, the real public spending per person on average increased by 21% between 2015 and 2019. Second, for the 30 countries with the highest debt payments, average real public spending per person fell by 6% between 2015 and 2018. The IMF did project actually a growth in average real public spending in these countries in 2019, but it will still be lower in 2019 than in 2015 by about 0.3%. The third key finding, which reinforces really this inverse relationship that we're seeing between the external debt servicing and the average real public spending, is for the 15 countries with the highest debt servicing, so the countries spending 18% of government revenue on debt payments or more, average real public spending fell in 14 out of the 15. This is the graph showing that index of average real public spending per person. So in the yellow line at the top, we have the 30 countries with the lowest debt payments. The orange line is the 30 countries with the highest debt payments. And then in the grey at the bottom, the 15 countries with the particularly high debt servicing. That's the countries spending 80% or more of their government revenue on external debt service and domestic debt interest. This shows it just as a straight comparison between the 30 countries with the highest debt payments and the 30 with the lowest debt payments. And as you'll see, the relationship between real public spending is basically reversed. Very striking mirror there. In terms of further findings, we also did an in-depth look at the 5 countries, five specific countries in each of those first 2 categories. And this provided further quite striking findings. So firstly, we looked at the 5 countries with relatively low debt payments and consistently rising public spending per person. So these 5 countries were Burkina Faso, Cambodia, Madagascar, Nicaragua, and Nepal. Here we found very limited use of private external lending. They were all making very low external debt payments to private lenders. 0% you'll see for Nepal and Cambodia, 1% for Burkina Faso, 0.2% for Nicaragua, and 9% for Madagascar. And again, when we looked at the opposite, the 5 countries with high debt payments and no sustained increase in government spending, again, we found the same pattern. So 4 of the 5 with high debt payments and no sustained increase in public spending all had significant debt payments to private external lenders. And you'll see the figures there, 63% for Ghana, 58% for Zambia, 58% for Chad, and 28% for Laos. The one exception to that rule was Sierra Leone, and it's quite an important case to look at. So Sierra Leone, all of its debt is low interest debt to multilateral institutions and to bilateral lenders, but it's still in debt crisis. This is because the government borrowed heavily from domestic and multilateral lenders in order to cope with the huge recession that Sierra Leone faced because of the Ebola crisis in 2014 and 2015. We believe it's really important to take note of Sierra Leone's experience because it shows that even actually low interest multilateral debt can contribute to and perpetuate debt crises if the loans are issued in response to external shocks rather than for lending for investment, which is exactly what is happening now for many developing countries in response to COVID-19. So moving on to the pandemic, to summarize perhaps first, so what the headlines of what we found is that the debt payments to 63 countries had risen by 125% from 2011 to 2019, that the IMF baseline and one economic shock scenarios mapped out prior to COVID still predicted rising debt payments up till 2022. And we have this clear relationship between high debt payments and cuts to public spending, particularly high debt payments to external private sector lenders. This was all before the coronavirus hit, and as everyone's no doubt aware, the pandemic has produced not one, but a series of major economic shocks for developing countries. There was a commodity price crash earlier in the year. Many countries have been hit by falling tourism revenues, with small island states being particularly affected because of their size and economic reliance on tourism. There's been a collapse in remittances linked to the economic crash in rich countries. And the pandemic has given rise to the largest capital outflow from developing countries ever recorded. So no one yet knows, as far as we have been able to find out, the full impact of the crisis on government revenue and debt payments. Since the crisis began, the IMF and World Bank have completed DSAs for 40 countries. 30 of these were published, though, before April or May time. So they only include the information that was available at the start of the crisis. Of these 40 new assessments, on average, they show external government debt payments to be 2 percentage points higher than in 2020 than previously predicted. But it's also really important to note that the IMF has published a more recent economic growth forecast for 17 of those 40. And in all 17, growth is now projected to be lower than the original DSA forecast. So even those recent DSAs now look overly optimistic compared to if the forecasts were actually to be produced now. So in terms of our conclusions, firstly, it's really important to point out, obviously each country has very specific circumstances, and we did find some countries with high debt payments where there hadn't been falls in public spending, and also some with low debt payments where public spending still had fallen. But our overall findings are that high debt payments mean a country is more likely to have public spending cuts. This means that debt crises were already contributing to falling public spending in a considerable number of countries before the outbreak of the pandemic. We also conclude that taking on private external debt is risky. And this is obviously something which is backed up by recent IMF research, which found that 20 lower income countries borrowing from international bond markets faced no economic growth in the 5 years after borrowing, and that the net impact was to reduce government revenues available for spending. And finally, we conclude that the debt burdens are preventing the large increases in public spending on essential services and infrastructure that are needed to make progress towards the Sustainable Development Goals. And the continued rise in debt payments threatens to make this situation worse. In terms of recommendations, we make a series of recommendations in the paper. Firstly, the findings point very strongly towards the adoption of a definition of debt sustainability, which is not based on whether or not a debt can be repaid, which is the IMF's kind of informal working definition, but on whether or not the debt is contributing to meeting the Sustainable Development Goals through useful lending and useful investment, or whether it's taking resources away from the meeting of the Sustainable Development Goals. The findings also point to the need for urgent action to tackle the debt payments that countries are having to make in the context of the COVID crisis. So along with over 200 global civil society organisations, we're calling for urgent action to tackle these debt payments. Specifically, we're calling for the unconditional cancellation of all public external debt payments to all lenders, that's bilateral, multilateral and private, for all countries that need it for at least the next 4 years, and also the adoption of a process to cancel debts down to a sustainable level. And then finally, in order to stop the boom-bust crisis, the boom-bust cycle of debt crises, which we've seen the last few decades, we also believe we need multilateral action, firstly on transparency, so the making of disclosure of loans to governments mandatory so that civil society and borrowing countries can more easily hold their governments accountable for new borrowing. And also for the IMF to stop bailing out reckless lenders. So to stop lending to countries in debt crisis without first requiring a debt restructuring, which is actually the IMF's policy, but which it hasn't been following over the last few years consistently, and obviously is not currently following in response to COVID-19. So those are the main findings and conclusions of the paper. I'm very happy to answer any questions, and I think the paper will shortly be available on, or maybe is already available on the website of the Centre for Global Development. Thank you.
Thank you so much, Sarah Jane. That presentation certainly made the stakes very clear. I'd like to now open up the discussion to our panelists, and we'll start with Sonja Gibbs. Would love to hear your thoughts on all of this, your reactions to the presentation and the recommendations as well. Over to you, Sonja.
Thank you very much. It's a great pleasure to be here, and thank you for having us today. It's a great discussion. I wanted to start with just an overview of how we see some of these fiscal challenges and debt stress and sustainability problems in the COVID era, as it were. And, you know, arguably, both emerging low-income countries, developing countries just are facing this perfect storm with the recessionary conditions, reduction in exports, capital remittance flows too. I'd emphasize these have also slumped, and Sarah Jane made tremendously good points here. Government debt is rising quickly for many of these countries as the full direct and indirect impact of COVID continues to unfold. Low-income country government debt is expected to rise, we project, by over 7 percentage points, almost 55% of GDP this year. That would be the biggest annual increase since 2000. And many low-income countries already had high and rising debt burdens prior to the crisis, now need to come up with the fiscal resources both to fight COVID and support their economies. And, you know, I wanted to highlight here that despite some normalization in spreads over the past several months, a lot of this is due to central bank liquidity, borrowing costs are still higher than pre-COVID levels, and there's been very little major issuance in international bond markets. So, you know, in some ways, this pandemic has sort of laid bare the need for kind of structural reform in sovereign financing for low-income countries. And one obvious problem is that many emerging and low-income countries simply can't provide the necessary fiscal support for a crisis like this one. So the G20 Debt Service Suspension Initiative, or DSSI, is a critical part of helping these vulnerable countries. Just to recap, the DSSI calls for official bilateral creditors to provide a moratorium on debt service through the end of 2020 upon request from the borrower, and for private creditors to do the same on a voluntary basis and on comparable terms. And I'll get to that in a minute. And as I'm sure you all know, an extension of the DSSI is under consideration, very likely to come to pass during the annual meetings. Just as an update, around 45 countries have applied for the DSSI, allowing them to delay a total of over 5.3 billion in repayments due to their official bilateral creditors this year. China, I think, is obviously a big factor here. About 2/3 of the debt service owed by DSSI countries is to China. And China's reportedly reached agreement with half of the 20 low-income countries that have asked for debt restructuring, and is reportedly finalizing an agreement with its largest borrower, Angola, before the end of the year, on suspension of, I think, 6.2 billion in repayments due through the end of 2022. So China has effectively already unilaterally extended the DSSI. But I want to raise a point of concern here. And Sarah Jane, you mentioned transparency, but the lack of transparency on how China is implementing the DSSI and lending policies more broadly remains a source of concern, especially when it comes to the distinction between what are commercial and what are official creditors with respect to China Development Bank and China Exim Bank. So let me now turn to private sector support for the DSSI. And as many of you know, there's been a lot of criticism as to why private sector is not stepping up on these particular debt relief efforts in the DSSI. And the answer in short is that first, for the most part, borrowers aren't asking their private creditors for debt relief. Grenada did ask and then rescinded the request. And more recently, Chad has asked commodity trader Glencore to suspend payments on its oil for cash loan this year. And of course, Zambia has quite recently set out a consent solicitation for its bondholders to suspend debt service. Just parenthetically there, I'd note that there's a lot of concern among the bondholders about the request, not about the request per se, but about Zambia being much more of a solvency case than of pure liquidity, which is what the DSSI was intended to do. So the rest of the 73 eligible countries haven't asked, and I should really say 25, because most of these low-income countries don't borrow from private creditors on commercial terms. So you're really only talking about the subset of countries that borrow in Eurobond markets. And unfortunately, why haven't they asked? I mean, the question comes up quite a lot, and it boils down to trade-offs. Commercial borrowing arrangements are priced and rated both internally by the lenders and externally by credit rating agencies. And unfortunately, asking your private creditors for debt service suspension puts borrower credit ratings at risk for a downgrade. And that raises the cost of borrowing and ultimately jeopardizes market access, something that really matters quite a lot to many of these countries. And don't forget that access to private capital is only very recent for many low-income borrowers, and they had to work hard to earn that access. And we've heard this time and time again from borrowers, including via the United Nations Economic Commission for Africa, or UNECA, that many borrowers just don't want to jeopardize this market access, that the trade-off for them isn't worth making. And the second reason that you've not had private sector participation in the DSSI is that the way it's structured just doesn't work well for the private sector because of the way loan and bond contracts are structured, the diversity of the creditor base, and in the case of bondholders, fiduciary considerations, and simply these market access questions. But I want to make a really important point here, and that is that private creditors do want to help. And obviously, these low-income countries are suffering a lot of damage. And given the substantial job losses and recessionary conditions, they've got to have short-term liquidity relief. So one of the things we did quite early on back in April was build a private creditor working group, which is banks and bondholders, lawyers, sovereign advisors. And this group has over 200 members from more than 100 individual firms, accounting for more than $45 trillion in assets under management. I think within that group, you have most of the major lenders and bondholders involved in credit provision to these countries. This is our sounding board. The people we turn to when the G20 asks the IIF to rally the private sector to support the DSSI. And here's a few things that they've conveyed to us via some survey questions that we have done. And many are actively engaged in discussion on ways to provide assistance with debt service to DSSI eligible countries and other vulnerable countries that have been hit hard by the pandemic. I'd note here the Specialized Africa Private Creditor Working Group established back in May, which works directly with individual borrowing countries. Many of our lenders, big global banks, have let us know that they're continuing to disperse under existing loans for ongoing projects. In particular, continued support for infrastructure projects and COVID-related budget spending has been a priority, including some with a specific focus on the healthcare sector, working alongside multilateral agencies like MIGA. And I'd emphasize here also that most banks that lend to low-income countries have long-standing relationships with borrowers and a strong interest in helping them through this difficult period. In fact, one of the global banks in our working group has set up a sizable COVID-19 response fund that donates to relief efforts. On the bondholder side, many are participating in new bond issues, including for some countries eligible for the DSSI, like Honduras, and others are actively involved in discussions with UNECA and the multilaterals on coming up with alternative and cheaper financing structures to help address these short-term liquidity issues. And I think it's worth noting here that both Ecuador and Belize, although these are not DSSI countries, approached their bondholders directly and negotiated temporary debt service suspension. So I think these are good examples of how this can be done with good faith negotiations. And in addition, I think many global investors are actively looking for more consideration of climate and related environmental sustainability factors in debt solutions. For example, SDG-aligned bond funds, partially guaranteed SDG bonds, or debt for nature swaps. We were talking the other day with some of our bondholders about debt for healthcare swaps. So there's many creative ways, Masood, you were saying earlier, need to think outside the box. And this is all directly relevant in the context of this pandemic. So many ways to achieve debt service suspension and debt relief more broadly, but for the private sector, there isn't a one-size-fits-all approach. There just can't be, given the way that private finance is structured. And there isn't a magic wand, and PV neutrality, for example, means different things to the public and private sectors. So a case-by-case basis is the best way to go. And we realize that's not straightforward. It's complex and time-consuming for borrowers to have to deal with individual creditors. So we've actually built a toolkit to make this easier, a private sector terms of reference, a framework agreement for banks, and guidance on consent solicitations for bondholders. One thing we really need to do is make sure that borrowing countries have full access to this toolkit that we have put together to help them negotiate with their private creditors, because that's an important piece of this, right? It's great to have the tools, but if they don't reach the borrowers, then they're not doing their job. And when liquidity problems bleed over into solvency problems, as they do, there are well-established tools in place to address these. An IMF program with policy conditionality and debt restructuring. And I want to stress here that any top-down, coercive, or mandatory approach to either liquidity or solvency problems would be really counterproductive, driving up risk premia, constraining market access, and ultimately jeopardizing private capital flows to these vulnerable countries. So I'll sum up here with 4 key points we've been communicating to the G20 this year. First, that private finance is an essential component of the financing equation. So preserving and expanding market access is vital. Taking on board that there are cases where private finance doesn't make sense for some of these countries. And second, that a case-by-case approach is unavoidable. Third, that the focus going forward needs to be on sound policies, ensuring those are in place, and long-term sustainability, including ESG considerations and support for the Sustainable Development Goals, along with much greater levels of transparency. And that's on the part of borrowers, on the part of creditors of all descriptions, including official, bilateral, multilateral, and private creditors as well. Many of you will know we have a debt transparency initiative in place. Happy to talk about that if anybody has questions. And finally, for vulnerable low-income countries, help really needs to be done in partnership, private and public sector together. In this context, we look forward to exploring solutions, including innovative vehicles with credit enhancement features that can make debt treatments work better in practice. That IMF paper that came out last week on a common framework for debt treatments beyond the DSSI also suggested some scope for looking more closely at such solutions. So I'll stop there, turn back over to you. Thank you.
Thank you so much, Sonja. Carmen Reinhart, can I please ask you to make your intervention?
So let me divide my remarks into 3 parts. The first is the historical experience. This is not obviously, I'm not bringing this up as academic note, but the historical experience, I think, is a useful starting point for comparison for actually what we're already seeing and what we are likely to see. Secondly, I'd like to focus more on what seems probable, not necessarily desirable, but probable in terms of what we're likely to see. And third, finally, what could different players do to not solve? I think we're kind of past that, but help along, ameliorate uh, the uh, the debt problems that in many cases predated the COVID pandemic, but have almost across the board made uh, the debt and economic conditions and all social conditions far, far worse than they were at the outset. So let me start with the historical experience. The historical experience usually, starts out, and Sarah, in her presentation, that was pretty evident in the slides. You start out during a period in which things look comparatively good. That for whatever reason, whether it was debt forgiveness, high commodity prices, better growth, or a combination of these things, uh, private sector and lending to developing countries, including the low income, looks attractive from you know repayment prospects and of course excess return, um, ex ante excess returns. So this time around, the current buildup of debt, which, as I said, predated COVID, uh, the stage for that is set by two elements precisely in that historic mold. One is the HIPIC initiative, which cleaned the balance sheets of external debt of many low-income countries that participated. And two, China's double-digit growth, which had a very large primary commodity input to it, made lending to many of the poorest countries and the middle income as well, but mostly so that combination led to a significant buildup in debt. And how do historically do those booms end? Well, I think we kind of know the answer to that. They typically don't end well. And the phases that the aftermath of the boom goes through is usually also fairly predictable. First there's a discussion of whether it's a liquidity problem or a solvency problem. In that interim period where it isn't as clear cut whether it's liquidity or solvency, usually there's some incremental lending, some bridge loans and rollovers and so on. The second stage, if it in the cases where insolvency is the problem and not a liquidity, usually there is the so-called case-by-case approach in which the can is kicked down the road. Namely, the first type of debt restructuring does not usually include face value write-offs. It's usually maturity extensions with some component of grace period. And the recent restructuring of Argentina and Ecuador are not low-income countries, but they are examples of that. The recent restructurings with China are on a similar mold. Namely, you extend the maturity, you give some sort of grace period. In the case of China, the grace period usually applies to principal repayment rather than interest repayment. In other words, debt ratios for those countries don't really fall because there is no write-offs. Also, again, going back to the historical norm, the country doesn't, the debt restructuring is not really successful in producing a significant reduction in the debt overhang, and therefore often ends up going back to the same creditors and starting another round of renegotiations. And the historic experience is one in which it takes about 7 years on average, to reach a restructuring. The numbers cited in the IMF recent paper are much less than that because they actually look at the work what my co-author Christoph Trebesch did, which is bond by bond rather than looking at the default spell, which makes an enormous difference because, as I said, of the repeated restructurings. And that's the path right now, unfortunately, that we're embarked in. You know, I think after the extreme scare of the spring and the perception that there is market access, that things have quieted down, I think the market access and things quieted down, as Sonja noted, importantly owes to the massive stimulus by the world central banks, and the fact that in a zero interest rate world, some high yield coupons are still, look worthwhile from the vantage point of risk taking. In other words, there's the eternal search for yield. Anyone interested, I have a paper called Sovereign Bonds Since Waterloo. We've been seeing this process on a repeated basis for not decades, but for centuries. So where does this leave us? Well, first of all, on the market access, I think the question of access is subject to interpretation. I mean, access at 8% yield coupons is very risky. Accent at 9.5% coupons, which was the bond issued by El Salvador, is even riskier. So access has been expensive, and in effect, the relatively more benign capital outflow from EMs seem to have reversed and so on. But since August, we seem to have also had, tightening conditions on capital flows to emerging markets. So what's next beyond this? Well, DSSI was the first emergency step. The idea was that instead of repaying creditors on a temporary basis, the countries would be able to direct those funds to emergency activities. So it was, liquidity relief. It again does not deal with the solvency problems. It's liquidity relief. And I will reiterate how disappointing it was that the participation by both private creditors and China, which was much less than full, has been. And of course, the equation of credit ratings and so on play into that. But I think, the initial emergency and this is, seen in the initial IIF letter of May, seem to have lost momentum and lost ground. And so the outcome has been that the amounts of relief achieved through DSSI have been much, much lower than they could have been. So what's next? And what's next is restructuring. And I agree very much with Sonja that it will be done on a case-by-case basis. And unfortunately, I think it will follow the pattern that it has followed historically, namely that private creditors and official creditors as well, historically have tended to delay on accepting face value reductions, i.e. creditors want to be repaid. And so my concern is that we are ushering in another decade-long, very slow-moving debt crisis. That's the concern. It's not a prediction, but it's a very real concern with a very high probability. And what would it take, and I'll conclude here, what would it take to shorten that span? I don't think for many countries we can avoid it. I think for many countries, about half of the low-income countries are either in debt distress or quickly approaching it. So what can be done? Well, I think on the financial centers, I think there are statutory laws that could contribute, anti-vulture legislation like in Belgium, or majority rules that try to level the playing field between debtors and creditors. On the part of China, getting the China Development Bank to participate, which is a major lender, including to Angola, would be a major step. And by renegotiation, I mean real renegotiation over and beyond what I've already repeated several times, maturity extensions and some temporary debt relief. And on the part of the private creditors, I think the recognition that it is actually not unwise to move to more aggressive debt relief sooner rather than later, because if you look at the historical determinants of the size of haircuts, they are determined by the magnitude of the contraction in economic activity. Well, obviously they're determined also by the initial stock of debt, but they are also determined by the cumulative toll on economic activity, the cumulative decline in GDP, and they're also determined by the duration, how long it took to get to that endpoint. So the longer you wait, the bigger the output decline, the bigger the haircut. And also haircuts are importantly connected to per capita levels of income. So historically, the poorer countries have received the bigger haircuts. So I think recognition that delay can also be extremely costly is very important. Let me stop there.
Thank you, Carmen Reinhart. Points well taken about the cost of delay and the slow-moving debt crisis that we may potentially be facing. I would like to now pass it over to Dr. Afari Opoku for his remarks. Especially, you have a very different vantage point and would like to hear in particular how you see a lot of the remedies that the international community is putting forward, and what tools from your perspective are missing in the toolkit.
Thank you very much, Clemens, and thank you very much to Sarah Jane and all the other panelists. I'm going to come at it, as you said, from a different point of view, from the government's perspective. And so I want to structure my intervention in three key areas. First, to start by looking at the impact of COVID, and then I'll look at how recent developments have complicated debt management, looking at the perspective of the government and using Ghana as a typical example. And more so, Ghana is important because if you look at Sarah Jane's presentation, that was clearly highlighted. And then maybe the last part, I'll look at the way forward and try to look at the toolkits and some of the areas that we think that could be tweaked or could be discussed. So first, to look at the impact of COVID. I mean, from the perspective of the government, we clearly had this unanticipated shock, and it was a huge public health crisis on the hands of the government. And most governments had to make critical decisions. First, to secure lives, and then second, to also reduce the social and economic burden of the pandemic on the vulnerable segments of the population. I want to quote what the president of Ghana said, which resonates with other low-income countries. He, in announcing the containment measures for the COVID pandemic, said that he knows how to revive economies, but he doesn't know how to bring back lives. And so clearly it was signaling the balance of judgment and in terms of the choices available. And this came up with a lot of huge fiscal costs. If you look at this whatever it takes approach, then it's coming at a very huge fiscal cost to the government, and whether there is room to actually accommodate this huge fiscal cost in terms of measures to cushion the vulnerable segments of the population, in terms of introducing other measures to look at those who are going to stay at home, the sectors that have been impacted. Listening to Sarah Jane, she highlighted a number of sectors that have been impacted. I mean, at the same time, we saw crude oil prices going very low. And you know, Ghana and a few more other countries are on both sides of this crude oil price market. So that was also compounding the impact of the COVID. Tourism went down significantly. I mean, zero. I mean, the hospitality industry was the most affected throughout this period, and so tourism went down. What was surprising, though, was that remittances held very firm, extremely firm. In fact, in Ghana, we saw that remittances did slightly better than we saw a year ago. And at our last MPC meeting, we had extensive discussion looking at it from the external payments perspective. We saw similar pattern during the global financial crisis too. That remittances held very firm. And we also are seeing the same pattern during this COVID environment. And what is coming out strongly is the fact that the Ghanaians, and for that matter, the low-income country citizens in the diaspora, especially are exposed to the health industry, the health sector in the diaspora. And this is a sector that actually was more engaged during the COVID period. And so these workers did not lose their jobs. They were not furloughed. They were actually working, unless otherwise they caught COVID. But other than that, they were working. And so at that point, they were in a position to continue to remit back at home. And that's what we've seen in BOP statistics, that remittances held very firm. We also saw that there were a lot of non-resident investors trying to leave. And I'll touch on that when I look at the management of debt management and the challenges in my second part. So this presented a huge fiscal situation to the government. In Ghana, the government had to suspend the fiscal rule in parliament to allow the government to be able to contain some of these fiscal costs. The central bank, for the first time since 2017, had to trigger the emergency support window because we had a memorandum of understanding to have 0% central bank financing to the budget. But for the first time, we had to trigger the emergency window, which is allowed by the Central Bank Act to increase our government asset purchase program to be able to make resources available to the government. Ghana had to reach out to the IMF to participate in the rapid credit facility. So these were some of the sources of financing that came in to be able to support. Despite that, we've seen a significant deviation from the fiscal consolidation part, and it is currently estimated that it will take about 3 to 5 years for us to return to that fiscal rule level. And that is going to complicate debt management going forward. Now, let me then, this quickly transitions me to look at debt management in Ghana, which I think will pick up some of these issues and throw out some of the challenges that low-income countries are facing. I mean, we will all recall that Ghana, as similar to other low-income countries, benefited from the HIPIC and the MDR initiative in 2004, 2005. Having said that, we have also seen that after cleaning the slate and the balance sheet, we are seeing the need for other sources of financing because of the huge infrastructural deficit gap that we have in these countries. And as a result of that, similar to other countries, especially frontier economies in the sub-region in Africa, Ghana introduced a couple of initiatives. The first one was to open up the domestic primary market to non-resident investors. Then the second one was to work very hard to access the international capital markets because we were seeing increasing financing gaps and financing needs, and the domestic market was not deep enough. The financial markets were not strong enough. The banking sector was not strong enough. The Ghana Stock Exchange was not strong enough to help to close this financing gap. And so reaching out to the international capital markets became a key source of financing of this financing gap. And so combining that with allowing non-residents to participate in the domestic market created an avenue for external financing of the huge budget deficit that was aiming at closing this financing gap. In the process, in doing that, this is what has happened. We have seen the share of sovereign bonds in the external debt stock in Ghana now reaching 42% as a result of Ghana going to the sovereign bond market for the first time in 2007. So between 2007 and now, the share of the sovereign bond alone in the total external debt is now about 42%, getting close to almost half of our external debt stock. Then in allowing the non-residents to participate in the market, we look at, in the domestic market, the non-resident holdings of the total domestic debt as at 2017 was 38.5%. But between 2017 and now, the share of the sovereign, the non-resident participation has gradually dropped to 20%. But it went as high as 38.5% of total debt stock. Clearly, this complicates macroeconomic management and debt management for these countries. Ghana is currently classified as a high risk of debt distress country. And secondly, our debt has become highly sensitive to swing in investor sentiments. Because to have about 38% of your domestic debt being held by non-resident investors, if you add that to the 42% of the external debt stock, that alone tells you where the external vulnerabilities that the country is facing. It was for that reason that the government took decisive steps to reduce the external non-resident participation in the domestic market, and that has been brought down from the 38.5% to 20% as we speak, and that is helping to reduce the vulnerabilities. So now that I've set that stage, let me then look at the way forward. And then before I look at the way forward, on top of all this, in 2017, Ghana also embarked on a huge financial sector cleanup. This happened at a time where we did not have deposit protection arrangements in place. So the cost of the financial sector cleanup also became a fiscal cost, and it also became part of the debt stock in the country. So this is where Ghana was at before COVID came. And so with the COVID coming into effect, it's coming now to complicate the already complicated debt management in the country. And so this is making it very complicated. And this is the basis on which I want to move quickly to the way forward. And I'll look at the DSSI. We see the DSSI as a very solid initiative that is going to create space, actually, for countries, low-income countries, to be able to have additional resources to be able to do that. But we have seen some limitations in the program. And all of them I'm going to talk about have been highlighted already. But for the purposes of emphasis, I want to look at two of that. The first one is the adverse impact that this participation will have on market access. And I'm saying this from the perspective that it is not just being able to get access to the market, but at what cost? At what cost? If you indicate that you want to participate in the DSSI, what will be the cost? What is happening is that most of these frontier economies in the sub-region have worked so hard to gain this market access, and this fear that if you indicate that you want to participate in the DSSI, it will send a wrong signal about the credit worthiness of the sovereign, and that will impact significantly at the cost of participating in the bond market. And that cost may be prohibitive and unsustainable. So you may be able to go there to raise at 9%, 10% coupon, but how is that sustainable to that? And then the second point, in addition to what has been raised that I want to touch on, is the heterogeneity of debt in the sub-region, especially for the frontier economies. These are economies that have over time reduced their official multilateral and bilateral holdings of debt. And so the DSSI is, in terms of scale, weighing it, unless we're able to get private creditors to participate, signaling to participate in the DSSI as it is only on the multilateral and the official bilateral terms does not provide enough space or relief for these countries that have very low levels of multilateral and bilateral debt on the desktop. So private sector or private creditors participation is very, very important to make the DSSI more meaningful to the frontier economies in the region, in addition to the signaling effect and the impact on market access and the cost of doing that. And so in terms of moving forward on the DSSI, I see it as a more enduring support that we can have is to look at how we correct the narratives of our economies in the international discourse, the narrative of frontier economies, the low-income countries, international discourse. Any opportunity that we get, we should be able to highlight the opportunities for growth and attractive projects in this region, which is growing far more than the global average. And also getting investors interested in impactful infrastructure projects that will enable our economies to be able to expand the capacity to generate higher sustainable and equitable growth. But perhaps more crucially, it is important for this discourse to look at how we can support low-income countries to strengthen and implement reforms at dismantling bottlenecks in domestic revenue mobilization and administration if we want to have a more sustainable debt management going forward. We see this as very critical. How to support low-income countries to define a feasible fiscal adjustment plan that will stabilize debt over the medium term, and how we also support these countries to ensure transparency in debt statistics and also ensure sustainable lending and borrowing, going into projects that have the capacity to pay for itself. Let me, for instance, in 2007, I was part of the team that went on the roadshow for the first sovereign bond for Ghana, which also happens to be the first other than South Africa in the sub-region. The entire discussion was on use of proceeds. Then after a decade, after I returned from the fund and joined the government team, I've gone on a number of sovereign bond roadshows, and the use of proceeds no longer is prominent in the discussions in terms of assessing the international bond markets. It looks very different. The discussion is very different from what I saw in 2007. And I think it's important to bring that into the discourse in terms of for these frontier economies to assess the international capital markets. But last but not the least, we should be able to support these low-income countries to build the capacity of the domestic financial institutions to be able to support domestic productive capacity. I'll end here and I think I'll continue the participation and questions. Thank you very much.
Thank you, Dr. Opoku-Afari. That last call was heard loud and clear, and very interesting remarks on both some of the contradictions inherent in the DSSI, and also a really interesting point about the heterogeneity of country debt. So with that, I'd like to now open this up to our group of invited guests for the second part of our discussion. So what I would say is to our guests, everyone should feel free to turn on your cameras. And then just a reminder that you can request to speak by raising your virtual hand. And then when you do take the floor, please do introduce yourself so the audience watching on YouTube knows who you are. So I'm going to start it by handing this over to my colleague, Nancy Lee, who recently put out a very interesting note on what's broken on the sovereign debt architecture on the private sector side. So over to you, Nancy.
Thanks so much, Clem. I think this has been an incredibly useful exposition of all of the dimensions of the challenges, as well as the different perspectives on the challenges. I want to shift gears a little bit. By the way, I'm Nancy Lee, Senior Policy Fellow at the Center for Global Development. So I want to talk about the very short term, as in next week, when we have the IMF and World Bank annual meetings, and we have the G20 meeting as well. And I want to make the case that IMF shareholders should seize this moment to give the IMF a mandate to develop some feasible but fit for purpose proposals in 3 areas. First, making the DSSI more workable for poor countries. Second, shifting into high gear for IMF finance, especially to poor countries. And then third, as these insolvency cases unfold and debt sustainability analyses are done, making IMF finance contingent on private sector participation, which I think will help address some of this protracted timeframes that Carmen was talking about. So first of all, on the DSSI, as Sonja has already described, it's not working very well. It was sort of an experiment in a sweeping proposal that offered all poor countries debt service relief by all creditors. But there's open conflict among official creditors about what an official bilateral credit is. And private creditors are rejecting participation to this sweeping proposal, and many debtor countries don't want to participate for the trade-off reasons that have been described. And the rating agencies themselves have basically defined comparable treatment across private and public creditors, which is the DSSI goal, as triggering events of default. So I don't think the G20 was wrong to advance the sweeping proposal. This is, if there ever was a moment of unprecedented crisis, this is it. It's the mother of all contagion episodes, and poor countries really can't fiscally adjust their way out of it. So, but if we're against one-size-fits-all solutions, we need a case-by-case approach. This, to me, means that the spotlight is clearly on the IMF. The only credible arbiter of which countries should be included in the standstill, it seems to me, is the IMF. And we need some kind of objective determination by the IMF, which identifies the countries which should be included. That is, those countries for which servicing all of their debt pushes debt sustainability farther away rather than closer, and worsens the ultimate haircut, as Carmen was describing. And we also need the official sector to work closely with rating agencies and financial regulators to enshrine what I think is a crucial distinction, which is that an individual debtor government's decision that it will not or cannot pay its debt service is not the same thing as complying with an external determination that a temporary standstill is in the systemic interest as well as in the interest of that particular debtor country. So I think going forward, bond issuances and loan agreements should have provisions that permit such a temporary suspension of debt service if the IMF makes such a determination for a given country. But for the present, in the absence of those provisions, I think all creditors and rating agencies and regulators need to come forward to agree that forbearance in these cases is the right temporary solution to avoid worsening problems in the future. So that's number one. It's not just extending the DSSI, it's targeting the DSSI better. Number two, we need this temporary solution, which is the DSSI. We ultimately need the long-term solution of debt restructurings for a number of countries. But to me, we also need an additional interim solution, which is large-scale IMF finance during this unprecedented global crisis, when ultimate debt sustainability prospects are unknown. So far, the amount of IMF finance that has flowed has been proactive, but it's relatively small, 31 billion at last count relative to the need. But the IMF rules prohibit moving forward with the larger and longer term programs in cases where there's no identified path to debt sustainability. So one of our participants today, Adnan, and his co-author Matthew Fisher have proposed to bridge that gap, a new facility at a time of unprecedented global crisis and in circumstances where the standard solutions that the IMF includes in programs, fiscal adjustment, financial, structural reforms, are not really going to work in the face of this massive and prolonged global shock. So I think it's time for the G20 and other IMF shareholders to give the fund a mandate to design and fund such a facility now, because it'll take time, so that it's available on a timely basis. And then finally, in the longer term, in the inevitable event of debt restructurings and haircuts, the default case has been that the public creditors, at least the Paris creditors, the Paris Club creditors have come forward first and provided debt relief, and IMF finance flows first. And it is uncertain for a long period of time how much private creditors are going to contribute to debt resolution. Collective action causes are shortening the duration of these events, but they're not a complete solution. So I think it's time to move forward with an idea that's been discussed for a long time, which is making IMF finance contingent on private creditor participation in debt restructurings. It's totally possible since IMF programs are dispersed in tranches. Programs could go forward with initial tranches and then link the later tranches to private creditor participation at a time when agreements have been reached between the debtor country and the private creditors. And there is, of course, the risk if you do that, that you will put the debtor country itself in the middle of a conflict between the IMF and private creditors. So I think I would also suggest that the IMF has to take a more formal role in advancing its own debt sustainability analysis, engaging directly with private creditors to explain the realities of debtor country repayment capacity. So in that case, private creditors would have to decide whether to participate in a debt restructuring that is actually supported by IMF finance or not. They would have to make their own determination about what is better for their own repayment prospects. So I think that's fair to private creditors, but it's also, I think, fair to taxpayers more fair than simply this extended period of using IMF finance to bail out private creditors without appropriate burden sharing. So let me stop there. I think those are three ideas. This is not a situation where we lack ideas. It's a situation where we need political will and we need practical implementation schemes, but we don't have a lot of time. These countries don't have a lot of time for all of the reasons that have been described. So next week is, to me, a critical potential decision point. Thanks.
Thank you so much, Nancy. Sarah Jane Clifton asked to come back in very briefly. So Sarah Jane, maybe we can hand this over to you, and then we have a queue of participants who would like to speak. So just to give a list, Stephanie Griffith-Jones will be after, followed by Michael Hugman, and then Adnan Manzarai. So Sarah Jane, over to you.
Thanks, Clemence. Yeah, I'll try and keep it very brief. I just wanted to come back on this point about market access, because we do think there is a degree of scaremongering that's going on in relation to market access by the private sector for obvious reasons, that the private sector wants to be repaid. So I just wanted to flag a couple of things. Firstly, as Carmen said, access is already very expensive for developing countries at the moment, but also yes, the seeking private sector debt restructuring would no doubt have an impact on market access for developing countries in the short term, but in the short term that wouldn't matter, because comprehensive debt payment cancellation would reduce the need for countries to borrow from private external markets in the short term. And then there's actually lots of evidence that a country which reduces its debt burden will be more able to borrow at lower interest rates from the market in the medium term, compared to one which continues to make debt payments but at the expense of an ever increasing debt burden. So that was a conclusion of IMF research in 2013, which found that debt restructurings have often been too little and too late, and thus failing to establish debt sustainability and market access in a durable way. And that same point was actually the conclusion of another research project by Scope Ratings in September of this year, which stated that if economies debt sustainability is adequately enhanced via public and private sector debt relief, this could support stronger market access and lower borrowing rates longer term, and with this potentially stronger credit ratings long term. So what that means is, for high debt countries, it is actually the restructuring of debt which will enable countries to borrow from the financial markets again in the future. Well, that is actually what the research shows anyway. Thank you.
Thank you. I will hand it over to Stephanie. And just as a reminder, if everyone we have quite a long queue, so if people could keep their interventions to no longer than two minutes, that would be very helpful, so we can get everyone an opportunity to speak. Thank you. Stephanie, over to you.
Thank you very much. Excellent panel, excellent comments, and very good paper. I just wanted to start, maybe it will sound a bit radical, but for me, it's a question of history, as Carmen outlined so nicely, and of common sense. I think that the prospect of returning to the private capital markets on a major and indiscriminate scale for low-income countries is not a good thing necessarily, because unless there are very restrictive conditions, which is, as Maxwell was pointing out, that the funds are channeled well towards productive investment and investment that will generate net foreign exchange, and that the funds will continue flowing in a sustained way throughout quite a long period of time, which we know doesn't happen. The risks of future debt crisis are always very high, and the risks, as the paper points out, of damaging effects to the local economy in terms of increased productivity and so on are also very high. So I think only in very restrictive circumstances, when the loans are long-term, ideally when the interest rates are fixed, when the money is well channeled to productive investment, which increases productivity in the economy, then I think it is valuable. But if that cannot be guaranteed either on the supply of capital side and on the country side, I think countries should be extremely low-income countries should be extremely careful about borrowing large amounts. And I must say that I was skeptical when Ghana, for example, started borrowing so much, and people in Ghana were very excited. I understand they want to do more development, they have pressing development needs, but on the other hand, so often the historical experience, particularly in emerging economies, has showed us that these things end in tears. So I think that's a note of caution. And I think, just commenting briefly on the paper, it's very good to relate that servicing to government resources, but I think it's also important to relate it to exports and future exports, because you have to service this debt in foreign exchange. I wanted to agree very strongly for the need of deep debt relief soon enough for those countries that need it, and sufficient liquidity. And I think that there is a problem with credit rating methodologies. Nancy Lee already briefly said it, because I think there's a lot of research, and Carmen also said it, which shows that timely liquidity relief, as well as timely debt relief when needed, actually increases future prospects. There's for example, a recent book co-edited by Robert Schiller with the IMF and the Bank of England that shows that contingency instruments like debt, GDP-linked bonds, which would postpone debt servicing in bad times, provides valuable debt relief, valuable liquidity relief, but also increases significantly the chance of countries being able to service. So it is in the interest of creditor countries. So I think the rating agencies' methodology should be revised and should be regulated. I don't understand why rating agencies are not regulated. They're a very important actor in the financial system, and we just throw up our hands in horror and say, why? Oh, we can't do anything because of rating agencies. Well, we have to change them. I mean, this is not, God-given. Finally, I would like to agree with Sonja, who was the only person who mentioned debt for development and debt for nature swaps. I don't think it's a solution, but I think given that we're also facing a climate emergency as well as a health emergency, it may be a good idea to, additional to debt relief that would have been granted anyway, one should link it to important programs, for example, for climate change mitigation. And this may actually increase political commitment to deeper debt relief. I think that's why it's important, because it combines, if you like, two public goods, which is sufficient debt relief for countries to grow and be able to pay creditors in the future, and contributing to climate mitigation and adaptation. I also just finally want to agree with Nancy Lee about expanding the resources of the IMF. And as it hasn't been mentioned before, I think an SDR issue, which would provide zero conditionality liquidity, or a distribution of IMF SDRs, as people like Mark Plant have suggested, I think it's really very urgent, and I hope that this could come out of the annual meetings, being a bit optimistic. Thank you very much.
Thank you so much. Thank you so much, Stephanie. Can I hand it over to Michael Hugman for a very quick remarks?
Thank you, Clemens. So very quickly, for those of you I don't know, I joined the Children's Investment Fund Foundation recently after 13 years as an emerging market bond investor and fund manager. Been working very closely with Sonja for the last 6 to 9 months on the DSSI. I think I want to just offer a few concrete points about other complementary practical steps that we can take in terms of market and policy development, because I think a number of participants have flagged that we need to actually move forward on these. I think it seems very clear to us that the private financing markets that we've created over the last 25 years are not fit for purpose. I would suggest very strongly, and I think Sarah Jane touched on this, that we do need, in the process of addressing that problem, and that will include restructuring the debt of a number of countries, to also offer a clearer vision of what we want those financing markets and for emerging market sovereign finance to look like at the end of that process, because we know that if there is a strong ex post vision of solvency and sustainable growth, that will make the impact of going through those restructurings much less painful, because it's a credible path to a much better position for those sovereigns. One component that we think is very important in that, and Dr. Opoku-Afari has talked about this, and we have put some proposals out there that we're going to be working on with organizations like the Climate Bonds Initiative around SDG bond taxonomies, and about the need to establish very strong partnerships between the official sector, borrowers, and private sector creditors around SDGs, and structuring financing to deliver those. And there was work that was done that I was involved in the mid-2000s for Nigeria on MDG financing delivery around the Paris Club debt relief that we could build on and use. I think we also need to look at blended finance solutions. I know there's some skepticism from some of Carmen Reinhart's colleagues about this, but I think there are a lot of facilities that can make sense to lower and make more counter-cyclical the funding costs for low-income countries. And this includes things like climate and nature facilities. And we're doing work as a foundation with the South African government around their just energy transition that fits into that. And I would just finish by saying that an appeal to everyone that I think we need to look at working out a convening structure for all the key stakeholders in this discussion. It needs to be established quickly. It needs to be established with very clear goals, not just to provide liquidity relief and manage debt restructurings over the next 12 to 18 months, but to build those sovereign financing markets that we need to see over the next 5 to 10 years. And I think all of us need to work on that together. Thank you.
Thank you so much. Can I hand it over to Adnan?
Adnan, you're on mute.
Maybe that way my comments will be even more thoughtful. I expect that there will be considerably more debt problems coming down the road. First, the WEO projections for 2021 are arguably optimistic. Second, the IIF has recently indicated that in the last 6 weeks, capital flows, which had surged back some since the lows of March, may be going down for a number of major emerging markets. And that takes me to the issue of private sector participation. The IIF, as has been mentioned, initially was very supportive of the DSSI, but over time it has not participated. And it has been rightly pointed out that the countries have not faced their incentives in such a way that they would ask for relief from private sector creditors. But one reason they have not is that the official sector has been bailing them out. And my sense is that to the extent that there are large emerging market problems, this willingness of the IMF and the bank to bail out the private sector will not continue. In an age of populism and political polarity, even in the affluent countries, they cannot afford to put out too much money for bailing out private creditors. Therefore, I also believe that there is a need for the IMF to have a less voluntary tool in its toolkit for declaring standstills and induce the proprietor to do that. Second, I also expect, and I see some evidence, that concerns about China are increasing. The issue is not just the size of China's lending, which is large, but also the terms. As has been mentioned, one issue is whether they are commercial or private. And more important, perhaps, are the size excuse me, the terms of these lendings, if they have collateral requirements, confidentiality requirements. And a major problem is the lack of transparency. I think the fund and others will participate, and China has been so far good, I would say, to a great extent, in contributing to the DSSI. But this lack of transparency is going to become, I think, a bigger problem. And I think it's going to show up in more frequent application of the IMF's misreporting procedures, such that debt sustainability analyses will be done, programs will be formulated, but then news may come that there is this or that China debt that has not been included. So the issue of transparency of Chinese debt is probably going to become much more important. I'd like to end also with a similar note as Stephanie about arguably we have too much capital flows. Okay, there's a paper by the fund's internal evaluation office, which is being rolled out tomorrow, which goes some way in recognizing that. I don't think adequately, fully. So there we may also see, I don't predict it, but we may also see greater willingness of the policy circles in the international financial institutions to consider more long-term impediments to capital flows, especially to poor countries. Thanks.
Thank you, Adnan. We next have Eric Lecomte, and then we will follow that by Steve Rosner, Susanna Gabel, and then Masood. Over to you, Eric.
Thank you. It's good to be with all of you today. I'm Eric, and I work with Jubilee USA Network. I think much of the discussion that we're having this morning is very important, and certainly the focus on the debt suspension payment initiative has been an important focus where we have to acknowledge that this process is important to allow for some breathing space. I think the broader component of today's discussion is now getting beyond the debt suspension payment initiative. I believe we saw last week from the G7 statement an indication on moving forward with a new framework to restructure debt. And I think right now, as we saw Kristalina Georgieva last week also call for a common framework that it can include many creditors and stakeholders, that's where we're looking at a focus for permanent debt reduction. And I think in our conversation, it's important to highlight three areas of concern as this process moves forward, as this process, I think, is absolutely critical right now in terms of what's the big enchilada, getting aid and relief to countries that need it most in a sustainable and permanent manner. So I think the first area is to what extent a new common framework, a HIPC 2 perhaps, will include private creditors. It's very clear from the G7 statement that they're indicating such a framework should include private creditors, where there have been challenges right now in terms of private creditor participation in the DSSI. We're now looking for how private creditors can be a part of the solution in terms of a permanent reduction framework. I think the second area that's very important to highlight is to what extent will this process or other processes be able to deal with developing middle-income countries? I think one of the great concerns we have right now about the current crisis is some of the greatest growth in extreme poverty rates, as well as where we're going to see the highest numbers of permanent job loss are in developing middle-income countries. When we're referring to lost decades of development, we're squarely focused on the challenges that these countries face. As the World Bank ended their meetings, the World Bank Development Committee noted that if the crisis worsens, if challenges continue for middle-income countries, beyond other aid and financing, middle-income countries will need to see debt relief too. So I think in terms of a framework moving forward, we need to ask how this process or other related processes will address this need where we're going to see some of the greatest challenges. And third, and finally, I think what we need to also look at as we move forward in the next few months with establishing this new framework is how it will move forward some permanent rules in order to ensure greater stability within the financial system. I think we've heard from a number of people today, the private sector, official actors, and others, the reality that we're facing when we look at the problems now because we didn't have the right tools in place. So we also have to look at how a new Paris Club framework, a new framework is also going to ask this broader question. How are we going to use this moment to establish new permanent rules to create stability and to create processes so that we are prepared for when the next global crisis hits? Thank you.
Thank you so much. Steve Rosner.
Thank you. Thanks for giving me the floor. Just briefly, I'm Steve Rosner, and I'm from the Office of Economic Policy at USAID. This has been a fascinating conversation, and I just wanted to add briefly just some points that are sort of separate a bit from the international financial architecture for debt and sovereign debt, and more focused on the issues on which I think that countries have more control over the long term. And this is where USAID, I think, comes into play as a development partner to many of our partner countries. The question I ask is not how are we going to get through this debt restructuring period now and avert the worst of what could be potentially very grave debt crises, but how to make countries more fiscally sustainable and resilient on the other side of this process. And how do you do it in a way that helps them stay that way and not end up in a similar position 10 or 15 years down the line? And one of the things that comes to mind for me is the need to focus on a few areas that are sort of within the core realm of public finance and policy and planning in the domestic space in these countries. One is public investment. We know that 30 to 50% of public investments in many of these countries we're talking about the benefits of them are lost to inefficiencies in planning and selection and implementation of their public investments. And these ultimately, they're interconnected with the financing that these governments take on. We need to think about how do we help them to select and plan these projects better so that the debt that they're taking does make sense, and that it is also linked into the broader objectives of the SDGs, as the presenter highlighted earlier on debt sustainability. Another thing that we haven't talked about here today is indirect liabilities, not taking on direct debt, but the sovereign guarantees for the contingent liabilities for things like PPPs, the debts of subnational governments and things like that, which for some of these governments are as large as, if not larger than, the external debts that we've been talking about. How do we wrap our heads around that? And how do we address those issues going forward? Because those things too contribute to this shrinking fiscal space that countries have to be able to respond to shocks like the current one that we're seeing. And lastly, I just sort of, I'll put something out there. It may be a topic for research or for further discussion, is what can donors such as USAID and our other donor partners, what can we do in this process where most of our engagement is at the bilateral level? We're not dealing in the international financial architecture. What can we do to help this along? We're ready and willing to be partners in this process, and we're eager to hear about what the ways in which we can help to move some of this conversation forward. So thank you, and I hand the floor back over.
Thank you. Let me hand it over to Susanna Gabel.
Thank you so much. I'm Susanna Gabel, CEDA's chief economist, and not unexpectedly, my comments were close to Steve's, so I'll be quick. But before COVID and before all these discussions about increased debt took off, we all talked about mobilizing capital. And my question to the panel today, and maybe the panels throughout this week, is how do you see this new debt situation change that agenda? Should we think differently about it? Is it just that everything we knew before is the same, it would just be harder? Or is it actually the case that we should think differently about it? Should some areas of that agenda is not relevant anymore, or will be less relevant than others? Is it better to talk about guarantees than domestic resource mobilization, and so on and so on? Or is it the fact, I mean, today we've heard about a lot of new thinking on how we can deal with the debt issue. Do we have new items on that agenda now that we should pay more attention to? Another way of asking that question is exactly what Steve was asking, from the perspective of a donor who wants to support this mobilizing capital agenda. Where should we put most effort? Is it to repay debt, or should we continue with our guarantees, or support capacity building for domestic resource mobilization, and so on? Thank you.
Thank you for your very good questions. Last but not least, I will hand it over to Masood, and then I will be taking 1 or 2 questions from the audience, and then we'll hand it back to our original panelists to each wrap up, provide some responses to these questions. And so over to you, Masood.
Thank you very much, Clemence. I was very struck by what Carmen said about the history and of how we tackle these problems. And if you look back, I don't think there was ever a debt crisis where we arrived at a solution too quickly. The history is always that we arrive too late at these solutions. And I worry that right now, the steps that are absorbing most of the political energy are really the small interim steps that are inadequate. And what we need to talk about, and political level focus, is really on, are we going to have a blanket package type solution for 15, 20 low-income countries which face unsustainable debt levels, and those debt levels have to be reduced? And is this going to require and force participation from all creditors, what the form will be? Are we going to radically scale up the financing from official sources on concessional terms to fund low-income countries over the next 5 years, because we don't believe that we are going to get private financing to come in any meaningful scale to finance low-income countries? If so, how are we going to make that feasible? So I guess my bottom line question is that we're not going to get necessarily big answers at the annual meetings in 2 weeks, in part because the annual meetings happen to take place 2 weeks before what is a very contested election in the largest economy in the world, the largest shareholder of these institutions. But we should use these meetings to try and at least identify and start to build consensus on the big questions, rather than spend all the political energy on the smaller questions. And I actually put DSSI in the small question category. And use that as a way of pushing aside the focus on the bigger ones. So for groups like this, the panels that are here, I would say the work that we can do is to keep raising the profile of the bigger questions that need to be addressed. Even if we don't get an answer in the next 2 weeks, at least we are going to be able to sharpen the trade-offs and choices that have to be faced. Thanks, Clemence.
Thank you, Masood. So we have a few questions coming in from the audience. The first is for Dr. Maxwell Opoku-Afari, and it's around, it's about Chinese debt. And in particular, this audience member is pointing to the fact that many countries in sub-Saharan Africa are looking to maximize their external sources of financing. And the question is really around what in particular makes Chinese loans so appealing for many countries in the region. And I think you may be on mute.
Yes, thank you very much. This is a very interesting question. I think what in particular makes Chinese loans very appealing to members in the sub-region. I think what quickly comes to mind is the processes that countries go through to be able to get access to financing for very large infrastructure projects. There are countries, apart from those that have access to the international capital markets, a number of sub-Saharan African countries do not have access to international capital markets. And so the access they have are to the multilateral and official bilateral agencies, institutions or creditors. And if you take a typical financing discussion with, let's say, African Development Bank or the World Bank, it takes close to 24 months for that to be done, to be able to release the resources for any infrastructure project or any big project. If you take a government that has a 4-year term that comes into power and wants to undertake a big project, and is going to use 2 years of that to be able to discuss with African Development Bank and also the World Bank to be able to get project finance or financing for infrastructure project. By the time he gets access to that, this government is already campaigning for either re-election or he's at the end of his term and is exiting government. So these are the challenges that makes access to debt financing from China in particular that comes a bit quite fast and focused on project-related financing. Remember, I made a point about even for the frontier economies that are able to access the capital markets, what has shifted between 2007 and now is a discussion on the use of proceeds. Most of these discussions are on project-related financing from China. And then when you look at the access to the international capital markets, more recently, such access, unless the country is disciplined enough to channel it into specific projects, come into the budget and it becomes very fungible for budget financing. And so these are the discussions and the complications that you see on the ground and why you see a lot more countries reaching out to China for finance.
Thank you. We have one more question from the audience, which I will direct to Sarah Jane Clifton, and then we will hand it over to our panelists for concluding remarks. The question for Sarah Jane is, what is the relationship between debt repayments and public per capita spending? And can you talk a little bit more about the nature of this relationship?
Sure, thanks, Clement. So that relationship was really the focus of the paper which I presented at the beginning. And what we see is a very sort of direct inverse relationship where the higher the debt repayments of a country, particularly the external debt repayments, the more likely the country is to face either a stagnant public spending or public spending cuts. And that relationship is particularly the case in relation to high external debt payments to private lenders, because those debt repayments are expensive.
Great, thank you, Sarah Jane. I'm now going to hand it over to our panelists for some concluding remarks. A lot of questions were thrown at you. And if maybe everyone could take around three minutes to organize concluding remarks, I'm going to pass it over to Carmen Reinhart first, who I know also had a remark she wanted to make during the moderated discussion. So over to you, Carmen Reinhart.
Thank you. It's really been a wonderful and thoughtful discussion. I think Stephanie raised a great point on the issue of too much capital flows. Others also have as well. This has been an area that I have been concerned about for some time, but I think what I really want to say is right now, and this is true of the IMF paper that was very recently completed, which is a very well done paper, but we are conflating what needs to be done about improving the future architecture and what needs to be done to deal with the current already precarious debt situation. And I think, you know, it might be counterproductive to try to commingle the two things at the moment. Let me also say that I am deeply skeptical that from a long-term view, these cycles of boom and ultimate bust are going to be a thing of the past, because memories are indeed short. And we are, you know, what we are seeing that at the moment is in terms of both the debtor countries and the creditors. And one thing that I've always said to many policymakers is, do not rely on the markets as a sign of market discipline, because, you know, that's not, it's not forthcoming until it's really too late. But I just wanted to leave the message that if anything that we can think that the creditors can do, that the governments of the G7 can do, I think I highlighted the role of legislation regarding debt restructurings. This is, and the debtors in terms of better negotiation and in debt restructurings is needed. I think those are the more immediate things than we have to tackle at the moment. And I very much agree with Masoud's takeaway that you know, let's not focus on the periphery. Let's focus on the center problem. I'll stop there.
Great, thank you so much. Sonja Gibbs, could I hand it over to you for some concluding thoughts from the panel discussion? Sonja, are you on mute?
Well, Sonja had to leave a bit early, so she's not with us anymore.
Okay, well then over to you, Dr. Opoku-Afari, for your concluding thoughts.
Thank you very much, Clement. I will also add my voice to Carmen's voice to say that this has been a very insightful discussion, both at the panel level and also contributions from the participants. I want to start off picking up on the history of how we tackle this problem and say that before COVID, most of the countries, especially post-HIPC economies in low-income countries, were already having elevated debt levels. And so in addition to addressing the liquidity challenges and the liquidity needs that have come as a result of COVID, it's also important that we look at the solvency issues that were already underlying these liquidity issues. And here, I think that as we discussed, the emphasis should be on how critical enhancing domestic revenue mobilization is going to be going forward, and also the effective use of proceeds for any future debt that is raised in low-income countries going forward. And lastly, but not the least, for the immediate or short-term solution, any effort that can be put in place to get private sector creditors to participate in the DSSI and having a framework around it to ensure that the fear of losing market access is very important. And then to one last point that was raised, which I agree with, is having rating agencies downgrading frontier market economies and emerging market economies in the midst of addressing the COVID crisis, and that having the need to also have these rating agencies being also regulated will be very important, since we now see them as very critical to the international financial architecture. It's important for them to be reigning, to be able to be regulated so that they don't have a free hand to be able to participate or take actions like that in the middle of addressing COVID, especially a public health crisis issue. Thank you very much.
And thank you. And with those remarks, we're reaching the close of our first panel. But before I let everyone go, I would first like to thank all of our panelists for joining and for making such thoughtful interventions. I'd also like to thank our special invited guests and for the very fruitful moderated discussion, and then also for the members of the audience. And I would like to remind everyone that we have 3 more sessions coming up this week. So on Tuesday morning at 8:30, we have a session on private sector financing. On Wednesday, we have a session on domestic resource mobilization. And then finally on Thursday morning, also at 8:30, we have a high-level panel to discuss all the ideas that were raised over the previous days and to look at for concrete actions to increase the level of international development finance. And all the links to these sessions can be found on the CGD website, which is cgddev.org. So with that, again, heartfelt thanks from all of the Center for Global Development to the panelists and to our discussants. And we look forward to speaking about these important issues again soon.